That's $40,000 that is potentially taxed at 37% or higher, even if you're subject to some additional taxes on that. And the mega backdoor Roth, I don't think that a lot of people are familiar with it. Instead of being taxed at your ordinary income rate, tax generated from options is taxable at capital gains rates.
Welcome to Retirement Done Right with your hosts, David Rath and Pat Kalish, where we talk about retirement, Social Security, taxes, estate planning, wealth planning, and more. Now, on to the show.
On today's episode, we're going to be discussing 5 lesser-known tax strategies that will benefit different people and at different times. And I would say that most people are familiar with the ideas of Roth conversions or 529 plans or basic tax strategies, but we're going to dive a little bit deeper today and go over tax strategies that I would say not everybody is potentially aware of. So in order to assist in the conversation, I brought Sarah Dorsey, CPA, who heads our Continuum tax team. Sarah, welcome to the podcast. Great to have you back.
Thanks. Great to be here.
Leading us off is going to be box spreads. So number 1 on the list is something I think that not a lot of people, if any, are aware of. And first, what the heck are they? It is a way for somebody to capture what are short-term rates in the market in a tax-efficient manner. I could easily get into the details here and bore everybody and lose all the listeners with our first topic of the day. So I'm not going to get into the mechanics of it. But basically, it is a way to get what would otherwise be an interest-bearing account like a money market fund or a savings account and do so in a more tax-efficient manner. So Sarah, I'm going to give you a softball question to start with. Mm-hmm. What is income generated from interest taxed at for an individual?
That'll be taxed at your ordinary rates, the highest one being like 37%.
So if you have, let's say, $1 million in a savings account and you're getting 4% on that money, that's $40,000 that is potentially taxed at 37% or higher, even if you're subject to some additional taxes on that. So that 4% is now down to 2.4% after tax, so less attractive than the nominal 4%, correct?
Yes, exactly.
So as I said, the mechanics of how these box spreads work, again, you can look it up online and see exactly how they work. There's a lot of Greek lettering and things that go into all this, and it is a very complex strategy. Yeah, you're not going to want to do this on your own. And no. The beauty of all of this is going to be that these are strategies that were previously available to institutional investors. They've been doing this for a very long time, capturing that short-term interest rate that's available in the market and doing so in a tax-efficient manner. So instead of being taxed at your ordinary income rate, tax generated from options is taxable at capital gains rates. And the split is going to be 60% long-term, 40% short-term. And so long-term capital gains rates are generally more attractive than your ordinary income rates, correct?
Correct. Yes. Yeah. For higher income, you're looking at 15-20%.
Which is, as we talked about in that 37% example, that's basically half of what you would ordinarily be paying for about 60% of the income that's being generated. Mm-hmm. Again, I don't want anybody to go out there and try their hand at this. It is very complex and you're not going to want to do it on your own. However, there are now investment products that are being introduced into the market that allow people to have access to this strategy and generate income or generate money that would otherwise be kicking off income that's being taxed at ordinary income. And they're doing so in a very tax efficient manner. Mm-hmm. So the flip side of that is going to be the fact that it's not FDIC insured. So if FDIC insurance is very important to you, this is not something that's going to work for you. And that's going to be a common theme throughout this episode is that these strategies are going to apply to different people at different times. And you want to make sure it makes sense for you and you are fully aware of all of the potential implications of doing this type of thing. So you want to look into it. If you're a higher earner and you have a lot of money in cash, this might apply to your situation because otherwise that cash that's sitting at the bank earning interest, you're going to be paying tax at a very, very high rate. And so if you can earn that same money, but now pay more beneficial tax treatment for it, I would say that's a win overall, correct?
100%. And this year these past few years with interest rates being so high compared to where they used to be, I had a ton of taxpayers over these last few years earning a lot of interest on CDs that they were all paying ordinary rates on.
Yeah, you see the CD rate and you're like, great, I'm getting 4%, I'm getting 4.5%. After tax, it's a totally different story. So if you can take taxes and at least mitigate the impact of them, it's going to be a win for you on your bottom line.
100%. Yep.
All right. So number two on the list is a Section 351 exchange. Before we get into what a Section 351 exchange is there like a sequencing of the numbers when they come out with these like different tax codes? Because I feel like the numbers are all over the map. Is there any rhyme or reason to how the IRS comes up with this stuff?
That's a great question. I honestly don't know the answer, but I know that this code has been around for a very long time. So I'm assuming that 351, I don't know. That's a good question.
But was there a Section 350 that this was just the next in line and then there's a Section 352?
That's what I've always assumed, but I'm just thinking about like all the other ones, Section 179 expensing. Did that come before this? I don't think so. So.
And like you have your 1040 when you file your taxes that you also include a 1099. Like, where do they come up with these numbers?
Yeah.
Is there like Section 1, like a Section 1, the original tax code?
I think we should do a podcast on that.
Yeah.
That would be really interesting.
Put a lot of people to sleep for sure.
Yeah.
All right. So we got off topic. So Section 351 exchange. Do you want to take a second to first describe what exactly a Section 351 exchange is?
Yes, I would. And that's why I was like rubbing my hands because this was such a cool thing when you mentioned it to me. So a Section 351 really was introduced so that it would incentivize people to start businesses. So if I want to start or invest in a corporation, I can take my assets and put them into a corporation. Let's say I have $500 that I want to invest in something that's worth $700. I'm effectively getting an asset that's worth more than I've put into it. And I don't have to recognize gain so long as I still control that same asset. So it was a way for people to invest in and start businesses while still using their personal funds in a way that didn't give them a tax impact immediately.
Essentially, you're taking the tax basis, what you paid for some original investment, and transferring that basis into a new investment. Is that correct?
Yep, exactly.
And you mentioned the initial idea behind this, behind the Section 351 was for starting businesses. However, I don't know if this is a new development or they just figured out a way to make it work with stocks and ETFs and things that people hold in investment accounts. But now there's even the option to do it within somebody's investment account. Is that correct?
Yes, that's right. Yeah. And it does seem like I think maybe people or very smart individuals figured out how to do this while still maintaining control of the underlying assets in a way that wasn't done before. So I think that it's more the right people looked deep enough into the code to figure out a way to make this advantageous for people that aren't just interested in starting a business.
And God bless those people. I don't know who wants to sift through that tax code and make all those petitions in tax law and tax court. But that's why we're here. We're here to reap the benefits for all the hard work that they're doing. And who would this potentially make sense for?
Well, I think it would be mostly for somebody that has an appreciated asset. Stocks that have appreciated in value would be my first guess about somebody. Or, somebody else that's feeling a drag from some of their investments, a tax drag. Is that your experience?
Yep. And that's exactly, you hit the nail on the head. It's people that have seen a lot of growth in one investment or maybe a few investments that they hold. It's in a taxable account. And now they're stuck with the difficult decision of having a large concentration. And everybody's heard, don't put all your eggs in one basket. But let's say you invested in NVIDIA back in 2013 and you've held it the whole way. Great. but you don't necessarily want to hold it as 60, 70% of your portfolio or whatever that works out to be. And so you're left with the decision of staying over concentrated in an investment or selling that investment and then getting killed when you file your taxes the next year. So this strategy steps right in there and allows people to take a highly appreciated asset, or actually a basket of assets, because I do need to mention that there are rules about concentration limits. If you're doing these exchanges, you have to have a somewhat diversified portfolio that you're moving into one of these 351 exchanges. And so you can take whatever that number works out to be and then move it into now a diversified basket of stocks. Let's call it something that replicates a US large cap exposure in an ETF. And so you take one stock and then you match it with some other appreciated assets in your taxable account. You bundle it all together, you give it to whoever is offering this service, and they're going to give you, in exchange, they're going to give you a diversified basket of stocks with this same basis that just transferred over. So now, again, you're in control of your taxes. You are able to sell that when it makes most sense, and you've mitigated some of that concentration risk. And that's the biggest part, is you have all of the success of the investment that you were so smart to get ahead of the crowd, and you've benefited from it. But now you want to be able to diversify your investments, and you don't want to get killed on taxes. And this is where this solution steps in.
Mm-hmm. Yeah, that's was my understanding. I'm so glad you explained that, though, because it's easy to read it maybe on a piece of paper, but to actually understand in practicality how that can apply to an investor, you just laid that out great. Thanks.
And this is one of those things that I get probably overly excited about, as firms are constantly pushing the envelope to add not only what investment outperformance via the strategies that they're offering, but also what is sometimes referred to as tax alpha, which is the ability to not upset your overall portfolio allocation and save on taxes. That's the sweet spot that a lot of these firms are gunning for, because it's a way to add value in a way that's tangible to people without displacing their investment allocation. And that's the sweet spot that everybody's shooting for.
Well, that I think is what excited me the most about it too, when you and I first talked about it, was that this was a whole new way for somebody that's doing everything that they can up until this point to reduce their taxes. Like, what else can we do? We've maxed out our charitables, this and that. This is just one other way that we can look at portfolios to try and save some tax dollars creatively.
Number 3 on the list is going to be mega backdoor Roth conversions. And I always chuckle when I see this title. It's just a ridiculous name. I feel like my 7-year-old named it. Everything is mega to him. So, the mega Lego building block that he's making. So it's a ridiculous name, but I think it's a really, really powerful tax tool, and one that I don't think a lot of people are aware of. And so if you don't mind talking about the structure of contributions to an employer-sponsored plan, let's say a 401k plan, what are the different buckets of money that are going into the contribution, and also the contribution limits into that 401k plan?
Sure. Yeah. So I think one of the things that's really misunderstood is there's a limit that you can contribute into an employer 401k plan. That limit is $70,000 in total. If you look it up on the internet, mostly what you'll see is what the employee portion of a contribution is, what they can defer from their regular current year income taxes. That's $23,500 plus another $7 if you are over 50. So there's 3 buckets that you can. There's the employee contribution, there's the employer match, and then there's this third bucket that equals up to that $70,000 max. And that third bucket is really, I think, what is misunderstood or just unknown at this point for a lot of people.
And I'm going to back up even further to just discussing pre-tax and Roth contributions, because honestly, I've seen 401k statements from people where they have this after-tax contribution into a 401k. Notice I didn't say Roth. It says after-tax contribution. It's sitting there in their 401k. They continue to contribute after tax because they think that they're doing Roth conversions. They heard out that Roth is after tax. It's very, very confusing, but there's essentially 3 different buckets of money that you can contribute to in your 401k. The first is pre-tax, very self-explanatory. You're going to be saving money on taxes up front, paying money on the back end when you withdraw it.
Yep.
Roth is the complete opposite of it. You pay taxes up front, it's tax-free on the back end. That third pesky bucket is one that should only be utilized, in my opinion, if you are intending to do this conversion or if you just have extra cash flow and you want to save in a tax-deferred manner. So we went through pre-tax and Roth. After tax is a little bit different. So after tax is contributions, as it says, on an after-tax basis, but any earnings that you're getting on that after-tax portion is being deferred, but then you're going to owe ordinary income taxes on that growth at a later date.
Correct.
Does that all make sense for everybody that's listening? It's like so confusing, and I don't know why there's not more education around this, but it's so important to understand that after tax does not equal Roth.
Yeah, right. No, that I hadn't really thought about that, but you hit the nail on the head. I mean, that is a very common misconception between those 2 different buckets and lines.
And I've seen 401k statements where somebody will have $70,000 in an after-tax portion. And I'll ask them, like, why did you do after-tax and not the Roth? And they're like, it's the same thing. And no, it's not. And now you're left with this tax bill that you otherwise could have avoided because on the way in, it's taxed the same as a Roth. On the way out, it is not. And if you're not aware of that, you're going to end up paying more taxes than you need to. So the strategy that we're talking about here is one where you are contributing up to that limit for your 401k contributions on a pre-tax or Roth basis. That was at 23.5 plus an additional amount for catch-up contributions if you're above 50. Then you have the employer contribution, which is layered on top of that. And above and beyond that, up to that 70,000 number is what you can contribute to after tax. And this is where the rubber meets the road with the strategy. If you just leave that money in after tax and it grows, as we talked about, it's going to be taxed on the growth. However, if you do conversions of after tax to Roth, which most plans allow for, you want to make sure that your plan does allow for it. If you do that conversion of after tax to Roth, you can now watch that money grow tax-free. And that's the biggest win here overall, is that money that otherwise would have been taxed at some point down the road is now going to be tax-free for you. And it's called a backdoor Roth for a reason, because it's kind of like the loophole in the tax code. I don't know if I'm allowed to say loophole live on air, but it is a loophole that people can get significant tax benefit down the road. So have you ever seen a lot of people taking advantage of this?
No, I haven't, honestly. And since you and I first talked about it, I'm really looking into more people that might benefit from it. I have a lot of people that say, I'm putting everything I can into my 401k. I'm putting everything I can into my HSA. I'm doing my annual backdoor Roth, but I still have extra cash. They're some of the lucky ones, right, that still have extra cash. What else can I do? This is a fantastic strategy for them. And I think one that I would say probably 2% of people at this point know about. And I think the other thing to point out too is with this intraplan Roth conversion, the mega backdoor, that's also beneficial for your beneficiaries, right? As if you don't need that money in that Roth, then they also will have the benefit of not having to pay tax on those distributions when they inherit the funds.
And the loophole aspect of this that comes into play is that there is no income limit for conversions, and you're basically cherry picking the after-tax portion of your 401k and converting it to Roth, and you're doing so in the plan. And so if there is any growth on that money in that meantime, let's say a common place is you do the after-tax contribution and then you convert every quarter, but that money might have grown in that short amount of time, and so you're going to owe a tax on whatever growth there is in that portion. However, I just came across a plan that does automatic conversions. They have the option to do automatic conversions of your after-tax to Roth. And so that eliminates any tax on the growth, or I shouldn't say eliminates it, basically gets rid of it for the most part.
Yeah.
And it allows the friction of doing this strategy, that goes out the window. And again, it makes sense the most for somebody who is a higher earner that is maximizing the pre-tax contribution to the 401k. So you lower your current tax bill. Mm-hmm. You don't want to be contributing to Roth, or I should say in general, you don't want to be contributing to Roth while you're in a higher tax bracket because you're paying tax on that money going in. So you maximize the pre-tax, then you have the employer match, and on top of that, you're doing the after-tax, because if you didn't do this, that money is going to be taxed. And now, as we talked about earlier, if you're putting that money in cash or you're putting it in a brokerage account, you're paying annual tax on dividends, interest, and capital gains. Now you're able to put that money into a 401k at a pretty decent clip, make that conversion, and now that money's tax-free. So I do know that this was something that they tried to remove from the tax code. I think it was for the Secure 2.0 as they were negotiating what was going in that. Yep. So it might not be around forever. Like if they are fed up with the fact that you're getting these people who are the quote unquote rich people who are now getting all this tax-free money in their 401ks, they might write that out of the next legislation in the tax bill. So make sure you take advantage of it. If you have any questions, feel free to contact me or Sarah. We'll look through your plan documents just to make sure you can do it. And if you can, now we'll analyze your overall situation. Do you have enough cash on hand? All the things that go into a proper plan, and then make a determination if it's right for you or not. Number 4 on the list. We're going to group this together. It's charitable contributions. And similar to the tax code, where they love the numbers when they come to exchange numbers and tax code numbers, we love acronyms when it comes to this type of stuff. So we're going to talk about charitable remainder trusts.
Yep.
We're going to talk about, hold on, I got to pull up my notes here. Donor advised funds, so DAFs, so CRTs and DAFs.
Yep.
And then we're also going to talk about qualified charitable distributions from an IRA, QCDs.
QCDs.
Did I get the alphabet soup right?
You did. It's like the triple threat of charitable deductions right there.
If you are just like Saint Nick when it comes to giving money away, then you need to be aware of all of these strategies. So very, very briefly, because there's a lot that goes into all of these things, but just talk about, first of all, what's a CRT, what's a DAF, and what is a QCD? And they're going to apply to different people at different stages in their life, right?
Yep, absolutely. So CRT, Charitable Remainder Trust, is a vehicle that you can use to, I see it most applicable to somebody with, let's say, appreciated assets, securities. And money goes into an irrevocable trust. It produces an income stream that can go out to whoever's putting the money in, the grantor, to their spouse, to other beneficiaries. And the best part is that when the money goes into that trust, the donor gets a charitable donation. It can be a current income tax donation, or it could be even an estate tax deduction. It's not for 100% of the value that goes in because you have to take out an adjustment for that income that's getting passed out, but it is typically a significant donation tax deduction.
So let me just make sure I can understand this. So let's say that you're in a similar situation to that 351 exchange that we talked about before, but you're much more of a giving person and you want to get the tax benefit by donating the money, but then also structuring it in such a way that you can still earn income from that. Is that correct?
Correct. Yeah. And it would be beneficial from somebody maybe that doesn't necessarily need or isn't tied to that asset for some reason, but does want the income to live off of, or wants their spouse to have the income to live off of when they've passed.
Okay, that makes sense. And so if you're selfish, you do the 351 exchange. If not, then you do the charitable remainder trust, right?
Or you could do both.
Do both, yeah, if you're really generous or you're really wealthy. So
yeah, exactly.
Now, donor advised funds, these are slightly different.
That.
And so can you go into the differences between those?
Yeah, sure. So a donor advised fund, similarly, it can be another significant tax deductible donation, but you're really losing control of the income stream of that asset. So again, it works really well for highly appreciated assets. You take your investments and put it into this donor advised fund. We can use an example of like the Community Foundation. So the Community Foundation is a charitable organization that receives large sums, and the donee, if I'm the donor putting the money into this, I don't have to make a decision on day one about who gets to receive my donation. So I have some clients that really like to research where their money is going when they're donating, but maybe this is a high income year for them. And so I'm recommending you should make a large charitable donation. So they might use a donor advised fund because they get that large charitable donation this year, but they have some time to figure out where they want that money to go from the donor advised fund, which charitable organization really fits their giving strategy, their personality, what's important to them.
Yeah. And this may have changed with the most recent tax bill, but in the past it was also, let's say you were contributing a certain amount per year, but you were not contributing enough to be able to itemize those deductions and benefit from that charitable giving. I know there's some new language written into the tax bill, but what we've seen is you can batch a few years of contributions into one of these donor advised funds. That way you exceed the limit necessary to get that deduction from these charitable contributions, and you're no worse for the wear because you are donating what you typically would have over the span of, let's say, 5 or 7 years. You're just now batching it into 1 year, right?
Yes, exactly. That's a great point.
Yeah. So again, these are strategies that you're taking money that you otherwise would have been giving away anyway and donating, and now you're just making sure that you're reaping the tax benefits from it that you otherwise wouldn't have been able to if you didn't plan accordingly, correct?
Yeah. Yep, exactly. And 2025, the donation rules are still the same. Nothing changes until 2026, where the one big beautiful bill has added a specific charitable donation for non-itemizers. So I'm encouraging people to maximize their charitable giving in 2025 because of other rules that have also come into play, that will come into play in 2026. With as far as if you're in the highest tax bracket, you could be limited in the amount of deduction you're allowed. And then there's also this new floor that's been instituted. So you have to give over a certain percentage of your income in order to be able to deduct it.
So good news all around. If you're getting rewarded from the government's perspective for donating your money, which you're not obligated to do, but those that choose to do so, I believe that it should be easier for them to make that tax deductible. So good progress on that front, but look into a donor advised fund if it makes sense based on the criteria that Sarah just talked about. And then the final one is going to be qualified charitable distributions. There are very specific rules in place about QCDs and when it's going to be applicable to somebody. So can you go through what exactly those are and who it would apply to?
Sure. Yeah. So a qualified charitable donation is one that's made directly from your retirement account to a specific charity. One caveat I will mention is you cannot do a qualified charitable donation to a donor advised fund because it's not going to one specific charity. So it has to go to one specific charity. You can only do up to $100,000 is the max giving limit. Where I see this happen, this is a great strategy for people that don't itemize their deductions prior to the new standard deduction that's coming out in 2026. So a lot of people that weren't receiving a tax benefit were able to still reduce their overall income by using these QCDs to reduce their adjusted gross income. So what happens is that comes directly off taxable income. There's no, it doesn't matter whether you itemize or not. And it can impact other things too. So, you have other income limits and deductions that are contingent upon your AGI. So this is another strategy to reduce your overall gross income so that you're not limited in other areas.
Does it count as a required minimum distribution? Can you use this to satisfy?
Yes. Yeah, that's the other good point too, is if you're somebody that your RMD is greater than what you actually need to live on, this can be another way to satisfy that RMD requirement without creating additional taxable income for you.
Okay, that's good news, because I know a lot of people that are in the RMD situation. They're not thrilled about paying taxes that they don't need to, and they don't necessarily need the money if they're taking RMDs and they're being forced to withdraw this money. So if they can use that RMD and just send it right to their charity of choice, I think that's a win-win, because now they get the tax break, they satisfy the RMD, and their charity that they support, they get the money.
Exactly. Right. Yeah, exactly.
Good. So we've flown through the first four, and now we're to one that I think you were much more familiar than me. I always get these emails from people running these funds that invest in what are known as qualified opportunity zones, QOZs. And so there's a lot of misunderstanding about what they are and how they operate. So can you talk through what exactly a qualified opportunity zone is, and who would potentially be interested, and then what are some of the pitfalls that are involved in this strategy itself?
Sure. Yeah. So a qualified opportunity zone is one that's been designated by the federal government as an area that's in need of rehabilitation. And so as part of that, there are these qualified opportunity funds have been established to encourage people to invest in these funds, to then take that money and reinvest it into these these areas that need to be rehabilitated. So a good strategy would be if you have some capital gain income. Let's say you sold a piece of property and you are left with a $400,000 capital gain on that fund, on that sale. If you invest that $400,000 into this qualified opportunity fund, you're able to defer that gain up until 2026 right now. So the qualified opportunity fund rules as they stand are set to expire as of December 31st, 2026. But I know that there is further legislation being discussed to do a second round of these tax benefits. So what happens is you reinvest these funds reinvest your gain into this fund. You don't pay tax on that initial gain up until 2026. So you're able to defer it, pay tax in 2026. But if you leave your gain in this qualified opportunity fund for 10 years, you never have to pay tax on any appreciation that asset has. And presumably it's going to have appreciation. You're investing in an area that needs rehabilitation. So you would assume that these assets would increase in value, not decrease.
And what are the requirements from a pure capital contribution versus let's say you invest in an area of an inner city, and are you responsible for like the management of that property, or can you segregate the two things?
Yeah, you don't have to be responsible for the management. You can find an investor that's already got this fund set up and just hand them your cash. I would recommend it's somebody that you trust, that you have vetted the organization that you're giving the funds to. But that's one option. Another option is, let's say you really do enjoy real estate investing. You can make what's called a captive qualified opportunity fund. And that's where you are involved in the, purchase, management, rehabilitation of that qualified rehabilitation. And in that sense, you would be, but that sometimes gives people a little bit more comfort if they're giving their money to somebody. They know what's happening with their money. They're not just relying on somebody to invest it properly and then manage that property in a way that is consistent with how they would want it to be done.
So all of the cold emails with the opportunities for these opportunity zones. That's more of the former instead of the latter, where these are a group of investors who are putting money together that are taking advantage of these opportunity zones, and then you're outsourcing the management and hopefully the appreciation of that said property or area, correct?
Exactly. Yeah.
And you mentioned before our call, as we were reviewing this, that there is a requirement in those 10 years of 100% appreciation. Rehabilitation. Okay.
Yeah. So the costs that you have to put into it, you're basically doubling the cost that you've put in. And that, again, that's also coming up in the legislation to reduce that percentage. So that remains to be seen. So I think, people, one of the risks is that it doesn't appreciate, right? That's one of the big risks. Another risk, or maybe this is something that it wouldn't be right for you, is if you're anticipating needing those funds within the next 10 years and you want to pull out of that investment, it's possible it may not have reached its peak by the time you need those funds. So those would be some of the things to think about. There are reduced percentages, so if in the first 5 years you need your money, you might pay less capital gains than you would have. But to get the full benefit, you have to leave it in there for the full 10 years.
And all of this conversation, including the first 4 things that we discussed, really highlight the idea of proper tax planning. Because it would be very easy for somebody to just go through life and take taxes as they come to them, where they're not familiar with some of these strategies and they're just getting their paycheck and they're investing money and they're sending money out and they're getting taxed on the interest, and there's no strategy to what they're doing. And I would venture to guess that those people end up paying a higher lifetime tax bill than an otherwise identical person who is doing their tax planning and taking advantage of the way that the tax code is written to still accomplish the same objectives, but do so in a tax smart and a tax efficient manner. Is that a pretty good overview?
Yeah, I completely agree. And I think that there can also be some stigma attached to some of these tax planning ideas. It's only for the super wealthy or, and I don't think that's always the case, especially something as simple as a QCD. That comes right off. Everybody has to get an RMD. It's not just the wealthy that need to get an RMD. So I think that there's tax planning that really can be had and can be done at any stage of the game or any level.
That's a great point, because there is this perception that tax planning is just for people that have multi-millions of dollars. Yeah. And while some of these strategies do make more sense for people in that situation, as you mentioned, there are definitely situations where anybody can capitalize. If you're a charitable individual and you don't have a ton of money and you want to take advantage of the tax code so that you're not paying Uncle Sam unnecessarily for making that charitable contribution, just a basic tax plan or a tax session where you're discussing what your options are can be really beneficial, so that your charity still gets the money and now you are not being overly taxed on that money that you're giving to them. And so that's a great point. And I think that's a great spot to end it, where all of these situations make sense for different people at different times. The only way to truly know if it makes sense for you is to talk to a qualified tax professional to make sure that you are considering all of the factors that are going into this stuff. So Sarah, we ran a little bit longer than normal today, but that's because, again, we get excited when we talk about tax stuff. But is there anything else that you want to leave the people with before we sign off today?
I don't think so. No, I think I'm good. This was great, though. It's always good to see you.
Always appreciate you hopping on. Thanks again, and we'll talk to everybody next time. Take care.
Sounds good. Bye.
Thanks for joining us for another episode of Retirement Done Right. To learn more, visit us at contwealth.com.